6/21/2020. Happy Father's Day to everyone out there. What we have is a weekly chart with some weekly indicators on it. Now, what we're going to say is that the pink line up there is a 50-week moving average, which is severe resistance. So if the Dow does not close above it, then the Dow is sitting on what we call a 150-week moving average, which is extremely critical. And not only that, the green line and the body of the candle of the price is a 100-week moving average on the Dow. And then the one declining, going down in value, is the 20-week moving average that's been going down in value. But it found support right there. Now, we're going to take a look at Panther, our platform, on a weekly. We can clearly see how the algorithms had worked, and they did. Now, what we're looking at, when I take a look, I can see where we're at on that Dow and where these support levels are going to come in on this weekly chart. And the thing about it is that the volatility has returned. Part of the Dow's problem here is the virus has come back into play and has started circulating rumors and that Apple is going to close down several Apple stores in different states where that virus has spiked. So now we start getting into this, and that was weighing on the market, because the market, as far as the Dow goes, it's in slippery territory right here. But what makes it very slippery is the 150-week moving average that my pointer is at right now. And the 200-week moving average is below the market. Let's just call it 24,117, somewhere right around there. Now, the chart in our market maker platform is not in bear cycle. Yes, they made a big move, and we all know that. But we also are going to be looking for a new algorithm that would push it and take it above this line that you see. That's our delta line in our platform. And if you follow that line back, it used to be a major resistance. Come down, hit it, and come down and hit it. Then it finally broke through and made all-time highs, pulled back, all-time high, pandemic, weekly down you went. And Jolly Roger came along, boom, algorithms were happening in our platform, weekly consolidation, breakouts. Mathematics do not lie in our platform. Now, when I take a look at the Dow on a daily, and I'll simply click over here on daily, and we're going to take a look at some key moving averages on a daily. And the 150-day moving average, the Dow went below it. That's not good, because people look at this stuff on a daily moving average. The weeklies are much more valuable to understand and how they're going to react. The problem that we had with the Dow up here at 26,319 is it didn't close above it, and there wasn't no buy side volume whatsoever to push it through it. And that is the reality of it. Let me tell you the other reality on it is the line that you see right there, which is a 150-day simple moving average on a daily. And that the 20-day simple moving average has been rising. The 200-day moving average, the white line, is serving as resistance along with the 10-day simple moving average. Now, everybody, all of our people, and it's at a daily sell signal too. And once the market fell into this daily sell signal here, this is what regular people that are hedge fund manager, money managers, institutional hacks, market makers like me in the market maker pit. You got the people in the stock pit. You got all of it going on. And so right now, this market is either going lower if it doesn't close above the daily moving averages. And when you have a 200-day simple moving average at resistance, that Dow has to close above it. So if you're buying equities and every time the Dow goes up and it can't go above that 200-day moving average, your equity price is going to fall right back down if you don't know how to be a seller. 99% of the people never know how to sell. So we're looking at it that way on a daily. And we're at critical moving averages. And the market started the problem when we could not take out this current high right here. And we have to get above that. And I told everyone that a few weeks ago. And then we had the big pullback like I said we would. And we tested some daily moving averages. You got resistance at the 10-day and the 200-day. And you have a 150-day, the yellow line. And then you have a 20-day, which is right there. And you have a negative bar. The Dow will have to get above that on a daily level for people to think that they can hold very long term at all in equity prices if they're buying stocks. We're our market makers in the option pit. And that's exactly what we do. So on the Dow, we can take a look at it that way. And we looked at it in our platform. We'll never be wrong. But let's take a look at this. Why don't we go to a monthly chart? And let's open this up and let's see what the Dow faces. And this is even worse. And I'll tell you why. That color line right there is a 20-month moving average. That dark blue line is a 10-month moving average. You can see where the Dow hits the highs. And what does it do? Here, let's draw a trend line. Right there. It sold off. Look, it sold off. And it went below those monthly moving averages. This pink line is very significant. And that's going to be a 50-month moving average. And every time we hit it, we undercut it. And they did sell below it. Oh boy, did they ever. But it came back. And we didn't finally regain this until 5-1 month. And we had resistance. And we shot above it. And we sold off. And we tested the highs up here on that monthly level. Yes, we did. And we called that high reversal. We told everyone what was coming down. That was 27,580. Yes, it was. And not only that, what even makes it worse on this one is the 200-month moving average will come into play at some point if it does go bad. So the 50-month moving average right around here, 23.7 would be support right here. When it comes down, it hits that support. We'll see if it bounces back into resistance. It made the higher highs here for the month of when it started to break out. This is the month of June, right? So let it not be confusing that volatility can return. And that, yes, it's Father's Day, and yes, markets should open up, but the fear of this virus contagion and businesses shutting down is not good. So, for the people that are not experienced, you could find yourself in a problem. The stock market rally has been bought and paid for by the Federal Reserve. Let's get that clear. And you had a 3 months where the Federal Reserve stepped in. Well, you had the bottom here, but you had the 3-month ACD breakout. And it goes just right there, just like that. And that's the top. And you got monthly moving average at resistance. Investors, if you're watching the video, if I were you, I would be extremely careful. And people that are traders know what I'm talking about. And our followers and account holders, they know what we're talking about. So there is risk right now until the moving averages that are currently the problem would become new support level. And then stocks would act good on their way up when you could buy and hold. Even for a few days, you can really make some good money. If this market fails, though, and starts to go down, and it has these issues right now, these monthly moving averages are not a joke. It's the 20-month and the 10-month. And the Dow has to close above 26,272. Has to close above it and go higher for the bull run to keep going. And I'm going to conclude the Dow. Happy Father's Day to everyone and whatnot. Let us not enter all of the kids around celebrating with the father today. I hope the Dow Jones enlightens you, gives you something to think about. Remember, the stock market rally was bought and paid for by the Federal Reserve. And, they can keep wanting to do more. But there is a short-term problem with the market again. And it's the circulation of the headlines. You get headlines, then it causes markets to go lower, of course. And we don't want to see investors get caught in that. And it's at that point right now. You can make a ton of money when it goes down. When everyone else is complaining, you have a big smile on your face because you're making lots of money when it fails. And that is where you get rich, when it fails or when it's good. If it breaks above it, well, then it's going to keep going higher. And then we would love that. So we're at that middle road with a high degree of risk. They've been selling in other sectors. I will give other updates about the key percent level of stocks trading above these moving averages that we are teaching people our way, the real way, and what the public looks at, okay? And how we operate around it and make money from what they say. The market's either going to do one of two things. It's either going to break out higher or it's going to break down. Breaks down, we get paid big. Breaks out, wants to go higher, we make money. It doesn't matter. But for a regular investor that's just looking at it, they're going to get whipsawed. And they are. And it happens. There's been a lot of selling across the board. And stocks are not cheap. But we're a market maker in doing the options. So our money goes a long ways. Always address risk. If you're not addressing risk, then you should not be in doing this. And risk is something that people don't like. But it's part of the reality. And that reality is going to make you so much advanced over everyone else. The higher advanced you will be. And you will. Especially when you're here with me. So I'm going to conclude the Dow. It's a special update, Father's update, all the fathers, all the market maker fathers, and all of the investor fathers, and the whole family's included. So enjoy the Sunday. Good luck to everyone next week.